Okay, hello and welcome everybody. Today we have Mike Zlotnik, CEO of TF Management Group. He teaches investors how to grow wealth through commercial real estate without tenants or toilets using data-driven underwriting and dependable cash flow strategies that work in all market conditions. Mike, the floor is yours. If you need anything, I'll be right here.
Thank you, Sam, and thank you, MoneyShow, for the opportunity to present. Hi, everyone. I appreciate the opportunity to be here. My name is Mike Zlotnik, also known as the Big Mike, and we'll get to that in just a minute. Today, I'm going to discuss deep value investing in commercial real estate versus some of the growth strategies such as crypto, Bitcoin, specifically Magnificent Seven. What is a better opportunity today? And I'm CEO and founder of Tempo Family of Funds. Just like it sounds, we are a family and we appreciate the opportunity to join our family. Well, wonderful disclaimer. This is for informational, educational purposes only. No advice of any kind, no solicitation. If you're interested in any of our funds or syndications, please request PPM to accredited investors only. Always consult with your attorney and CPA professional before making any investment decisions. Just a couple of words about Tempo. It was started 2009. I was one of the co-founders. We've raised and deployed over $150 million in equity capital across various investment strategies in commercial real estate, over 100 equity investments. We have over 800 investors who have entrusted their capital with us, and we greatly appreciate their trust. We've done over 1,600 loans in various strategies, various markets. We have deep expertise in both equity and debt investments. And I personally started investing in real estate in 2000 here in New York City and have been investing in various strategies all over the United States. All we do is real estate, and all we do it in the United States. Our deepest value is buying deep value deals. This is where we pride ourselves, especially in today's market. We'll look for opportunities where you make money on the buy, with the distressed, motivated sellers in great markets. And we look at acquisitions based on data, multiple things. We'll give you some examples of how we buy. But to make long story short, it's a deep value buy today. As you know, the Fed has pushed interest rates higher for longer. And as a result, we see phenomenal opportunities today in commercial real estate market. It's not a game of throw what and see what sticks on the wall. It's a game of finding great opportunities, outstanding deals. It's like a precision. It's like a surgery, in a manner of speaking. Our specialization is conservative underwriting. We look for downside protection while maintaining great upside through these type of investments. And our interests are always aligned with investors. The whole investment thesis structures, fees, completely aligned with investors as part of what we do. A couple of words about our wonderful team. As I mentioned, I go as a Big Mike. I am 6'4", big guy, and I run a podcast, Big Mike Fund Podcast. That's why you see bigmikefund.com together with the corporate website, tempofunding.com. A wonderful team. Diana leads our investor relations. Ryan leads our capital markets. We have two gentlemen named Yuri. We hired them because of the first name. Just joking. It just so happened that we found two great gentlemen with the first name Yuri. One is the chief investment officer and one is chief technology officer. Let's talk a little bit about the big picture. First, growth versus deep value. So we've seen phenomenal market run in stocks, especially Magnificent Seven, as well as Bitcoin. And they're riding on high momentum. AI-driven transformation is revolutionizing our wage. There's widespread optimism to the point of potential euphoria. We've seen this show before, and I mean this with all due respect to Bitcoin, crypto, and Magnificent Seven and other stock investments. The run can continue, but it feels a little bit like 1998, 1999. Ray Dalio has mentioned this on one of the recent podcasts, that's what the feeling is. We're not at the peak of the market yet, but we're getting there. It feels like these valuations approaching stratosphere, and everything is set for perfection. Can this run continue? Absolutely, it can. But relative risks have increased. Howard Marks teaches us that the higher the price, the higher the risk. So we've seen an unbelievable great bull run, and the risks profiles for investment strategies have changed. When you look at the private commercial real estate deals, and I mean private as a specialty trade, there's of course publicly traded REITs and there are private opportunities. One of the strengths of commercial real estate market, the deep opportunities exist. It's an inefficient market. What it means is publicly traded securities are efficient. The market discovers the price. Inefficient markets is where you could actually find deep value deals through your network, through motivated seller situations. And that's exactly what we're doing. Current market can be characterized by deep value, discounted pricing, robust cash flow, and heightened fear. There's a lot of fear that the commercial real estate market has been depressed, and that's the best time to consider these type of deals. And the deals we're finding are already phenomenal. We'll show you a couple of great examples. And Warren Buffett teaches us, be greedy when others are fearful and be fearful when others are greedy. There's a significant greed in Magnificent Seven, Bitcoin, and crypto, and significant fear in commercial real estate. This is the time to consider being a contrarian investor. So what's helping Magnificent Seven and Bitcoin in general and crypto? It's a growth story. It's a wonderful growth story. AI enthusiasm continues to dominate markets. We are seeing digital asset adoption. The current administration has been very friendly to everything crypto. So we've seen phenomenal support to the market from the political environment as well as just huge investment. In 2024 alone, we've seen numbers to the degree of 100 to 200 billion just infrastructure investments in AI technologies. These numbers are staggering. So no question about this massive investment has grown GDP, has given this economy great momentum. But the consumer is weak, and there are many other factors that are giving us concerns. Where we go from here, only the time will show. Of course, AI is transformational, no argument, no question about that. But the valuations has reached the point of a stratosphere, and the risks have increased. So again, momentum is there, the risks are higher. And one significant benefit of Magnificent Seven and Bitcoin, these are publicly traded assets or securities. As a result, there's high liquidity. We'll compare that to real estate that is generally less liquid. There are hidden risks. In general, we've seen volatility in Bitcoin and crypto. Mag 7 could also be volatile. Other stocks could be volatile. At the moment, volatility is low, and that's the time of the most caution when things looking perfect. Past results are not indicative of future performance. The trends do break. So risks have increased. While the volatility is low, investors are complacent. This is the time to actually pay attention to what's going on and consider where the deeper opportunities exist. Anyway, there's a speculative AI arms race between the US and China, and it's win at all cost, regardless of ROI and timelines. It could be a winner-takes-all type of a scenario where a few significant winners emerge and many companies fall the way they fell in the dot-com boom days. Once again, investors are complacent, and then there's a herd behavior. Let's look at deep value real estate, discounted and great opportunities that we are observing today. And it's not a theoretical discussion. It's a game of surgery, game of finding these phenomenal opportunities and capitalizing on them. So many investments trade 30 to 40% below their peaks of 2022. Deeply discounted valuations and relative prices to the reconstruction costs, often below 50% of reconstruction cost. It's a buy low opportunity with outstanding upside potential in terms of target IRR based on conservative underwriting with a very low leverage debt. Banks are generally very conservative on lending side. So when you're playing equity, low leverage and great upside create a asymmetric return profile. Well mitigated risks while significant upside through the buy low and upside through the value add and other opportunities. There's a huge margin of safety. Benjamin Grant talks about margin of safety. And today, in commercial real estate, we're seeing deals with strong margin of safety in the form of positive equity spread. So what is an equity spread? It's the delta between the capitalization rate or cap rates you are buying at minus the mortgage rate, what you are paying for the debt. And that spread today has reached on many deals 2% or higher, which creates a significant safety for our ability to pay debt service and as well as downside protection. It's very easy today to find yields on these commercial deals well above treasury rates, easily 6 to 8% range on many conservatively leveraged deals. So it's a strong initial yield while great downside protection. In addition, we just got the one big beautiful bill. 100% bonus depreciation has been restored. And that's a huge tailwind for commercial real estate. It magnifies tax benefits from the past 40% bonus now to 100%. So we expect this to be a significant help to commercial real estate investing for the coming quarters and years. Let's look at the competitive landscape. On the income yield front, the yield is very low, if any, when you invest in crypto or Magnificent Seven. Compare that to the private real estate, where you can easily get 68% initial yield. Total return, uncertain. It's a speculative investment, growth oriented in Mag 7 and crypto, while in commercial real estate, it's very easy to underwrite for high teens into 20s IRR based on very conservative assumptions. Liquidity is high in publicly traded investments, and it is low in long-term real estate investments. Volatility is generally much higher in these growth-oriented investments versus commercial real estate deals being bought deep. Volatility is perceived to be low to moderate. Fundamental value, hard to estimate. It's priced perfection in Magnificent Seven, AI-driven investments, crypto, while in commercial real estate, we're looking at predictable math-driven underwriting with a lot of clarity, rent escalation clauses, high credit quality tenants. We'll talk about that a little bit later. Tax benefits, again, this crypto, Magnificent Seven, yeah, appreciation is long-term capital gains. The rest are no additional benefits. In real estate, commercial real estate, there's strong tax benefits. It's one of the most tax-advantaged asset classes. And bonus depreciation, as well as normal depreciation, create a phenomenal tax advantage for these type of investments. And gains are also treated as long-term capital gains. Risk-adjusted ROI, it's uncertain in Mag 7, Bitcoin. It's speculative. It could do great, or the market could turn around. In deep value buy real estate, it's asymmetric return profile. There's always risk, but the risk-reward ratios on these transactions look heavily upside driven and very downside protected. Market sentiment is very bullish and greed is high in these investments that have done really well in the past. While commercial real estate, there's a lot of, let's call it fear caution. And that's exactly the time to come in. It reminds me, once again, back to Ray Dalio. We are 1999, 1998 timeframe on the stock market, crypto, while the way I would compare to commercial real estate, we are just after the crash and beginning of recovery of 2008, 2009. Maybe we are somewhere in the 2009, 2010 early recovery of commercial real estate. This is an equivalent of that thinking. So once again, as I said, market cycles. So the market cycle appears to be at the peak for the stocks. Now, can they continue to do well? Absolutely they can. It's just the risks have increased. And prudent investors consider rebalancing of the portfolio as well as diversification, taking some chips off the table where they've done really well, and deploying that capital into what is a deep value. Market cycle for commercial real estate is at the bottom of the cycle, early recovery. We expect some level of interest rate cuts with the Fed starting from the September meeting. We'll see what happens. A lot of uncertainty, inflation versus unemployment. But it feels like there's only one direction to go, down. Obviously, President Trump has pushed for significant cuts, but Jay Powell appears to be more hawkish. Nonetheless, over the next 12 to 18 months, it's pretty clear that the interest rates are coming down. Very likely scenario. That'll be significant tailwind for commercial real estate. Now, it can help stocks, of course, too, but commercial real estate trades on leverage, and it's got a lot more upside from lower interest rates than stocks in theory. Again, value-oriented investor, contrarian thinking, there's a much better opportunity in commercial real estate today. Make the money on the buy. That whole theory is, this is how I started investing in real estate. Can you write a check into an investment with a steep discount on the as-is basis? And these opportunities exist today. So can you grow your wealth with a margin of safety? Yes, you can. Contrarian position against market extremes, that's another philosophy. And superior risk-adjusted return. That's the best way to describe it. Looking at the risk-reward, commercial real estate today looks very attractive. Not as a broad strategy, buy everything. This is more of a precision. Find distressed, motivated seller situations. We see the markets. There are transactions where people overpaying left and right. They're just buying for the sake of buying. I am talking about deep discounted opportunities. We're finding them. It's not a game of quantity. It's a game of quality. So here is the first example. This is a recent deal. Literally, this closed last Friday, August 15th. This is a property downtown San Diego, the headquarters at Seaport. It's an open-air retail. It's a historic structure that cannot be torn down. It's an historic registry. Phenomenal asset, beautifully maintained, but it's got some upside through multiple things that I'll mention right now. Its location downtown San Diego, next to the convention center, next to multiple hotels. It's 5 to 7 minutes walk to the USS Midway Aircraft Carrier Museum. It's in a perfect location. The weather is perfect. It's got a beautiful courtyard, ton of upside. And this deal is underwritten very conservatively for target returns in the very high teens, as well as initial cash flow. So let's talk about numbers. This is the beauty about commercial real estate. You can actually do the math. So acquisition on this property is 9.25% cap rate. It's a great deep value buy. It only 84% occupancy. What it means is this 16% to lease up, and the deal is financed with very conservative 57% mortgage at 6.5% fixed rate debt. If you look at this, it's a phenomenal downside while huge upside. Initial yield of 6% plus, as I mentioned, target IRR in the high teens plus. It's a value add opportunity through capital improvements and additional lease up. The tenant mix on the as-is basis is very strong. High credit quality tenants like Cheesecake Factory. Puesto is a great Mexican food restaurant. Eddie V's seafood, Starbucks, long-term leases, high credit quality, rent escalation clauses. As I mentioned, prime location. There's no supply nearby. The only thing near it is Seaport Village, and it's 99% occupied. So this property has significant supply limitation and still a lot of lease-up upside. And then Royal Caribbean is expanding. It's announced a new ship being docked out of San Diego port, which will be going to Mexican Riviera. So enough on this deal, just a couple of final words. We actually reserved a little bit of room on this deal closed last Friday, but we reserve a little bit of room specifically for MoneyShow folks. If you have interest, please reach out, request PPM, talk to our team. The space is very, very limited. We just wanted to give the opportunity because of the alignment of the closing and the MoneyShow to open the opportunity for MoneyShow folks like you. Let's talk about another deep value buy. This transacted first half of the year. Very different asset. It's over 1,000 doors in near Ann Arbor, Michigan, in a town called Belleville, on a beautiful 10-mile long lake called Waverly on the Lake. And this property is an insane deep value buy. We're so excited about this project, but this is an example of the kind of transactions can take place today. So target returns are projected in the low 20s, but it's got a lot of potential. It's a very conservative underwritten deal. It's got great cash flow from day one. And here comes bonus depreciation. With 100% bonus, the deal is structured so that the common equity actually receives 2x for every dollar invested in the deal. So investors write a 100K check and they get a first year loss driven by bonus depreciation of 200,000 or more through a deal structure. It's a phenomenal tax benefit from day one for those folks that can appreciate how much upside it's got and how much tax benefits and the downside protection. Let's look at the math on this deal. As I mentioned, conservative underwritten, low 20s, very healthy equity multiple. It's being bought. It was bought at 9 cap on purchase with the 7% debt financing rate. That's 2% positive spread. That's a margin of safety. As I mentioned, bonus depreciation with 2x benefits. It's literally on a 10-mile long lake with the boat docks that belong to the property. It's just a phenomenal location, and it was bought at $79,000 per door, while this type of property was trading at $125 per door in 2022. It's about 35% or greater discount on the as-is basis with a motivated seller. It's a phenomenal deal. Current as-is rent per door, $1,150. And at the acquisition, it's 50% below reconstruction cost, which is likely to be about $200,000. It's a phenomenal make money on the buy. The value add opportunity post-renovation, the area supports rents easily at $1,550, $1,600 a door, and it's very, very affordable. Southeast Michigan affordability is very, very high. So it's a steady Eddie market where this asset has got a ton of opportunity through apartment renovations. There's great proximity to multiple colleges, including University of Michigan in Ann Arbor, Ford plants, other big employers. The other really interesting thing, this specific property has old ceramic heaters. And we have been already approved with the utility company through a letter of credit or equivalent for the reimbursements. 75 to 80% of the investment gets reimbursed by the utility company through their energy efficient programs. And the new HVAC units expected to save residents $300+ a month. This is an insane tax benefits. It's a green project. It's a phenomenal opportunity. So we're very excited about this type of a deal. And this is what we're looking for every day. We're looking for these type of deals day in and day out. So let's talk about what is deep value commercial real estate deals look like today. So it could be industrial. We're looking at these deals. We have a strong pipeline there, open air shopping, multifamily, many other strategies. Folks can look at investment in common equity with the best economic upside as well as great tax benefits. Folks could look at preferred equity or mezzanine debt for higher safety and better cash flows. People can look also at primary debt, private credit for higher safety and strong yield. Deep value deals that we seek come to us from the best class sponsors, operators, partners. We have long-standing relationships. We get all our deal flow 100% on existing relationships and connections we have. So let me explain the buy box. This is what we do day in and day out. We look for motivated seller situations where we make money on the buy, on the as-is basis. We look for strong initial cash flow with 2% equity spread. This positive spread creates a margin of safety and it creates cash flow from day one and downside protection. We'll look at conservative LTVs. As I gave you examples of the deals, often sub 60% leverage. In some cases, you could be 65%. You can even go to 70 theoretically. Like multifamily, typical leverage 70%. Industrial, open air shopping, the leverage is typically 55 to 65%. That conservative leverage works both ways. It's great for lenders and it's great for investors because it creates strong downside protection. Asymmetric risk adjusted return profile. To make it very simple, we've been learning from Warren Buffett, Charlie Munger, Benjamin Graham, how to buy deep with risk reward profile being strong upside on the upside and well mitigated downside risk. This is the philosophy. This is what we think. This is the mindset. We look for these type of deals. And these are the examples that I gave you of two great deals that we found this year. We're not looking for volume. We're not looking for quantity. We are all about quality, great deep deals. We do typically 3 to 4 of these type of deals per year. They're all about great deep buys from the motivated seller situations. Clear, easy to execute value add plan. Very simple, very well understood, very predictable. Of course, there are complexities and risks in everything, but we do deals that focus on improvements that are easy to execute, renovating apartments, exchanging old heaters for new energy efficient, or on a open air shopping, finding the right type of tenants with long-term leases, high credit quality. These execution strategies are very simple, straightforward. Compare that and contrast to the speculative strategies, such as building ground up or doing heavy redevelopment, repositioning. We don't do that. That's not our play. Our play is deep value investments. We make the money on the buy. That's the mindset, with an easy and clear to execute value add plan. And most of these acquisitions transact at well below replacement cost or reconstruction cost. The reason it's important is you can get a deep discount on existing. You cannot get a deep discount on new construction. It's going to cost to build what it's going to cost to build. Time overruns, cost overruns. Those are risks. We don't want to be playing in those areas of risk. We can get a discount on the as-is basis on existing asset with a motivated seller. Well, enough of this super exciting stuff. Let's talk a little bit about fun. I have a podcast with a cheesy name. People have called me Big Mike. When I was launching the podcast, I couldn't come up with a better name. I'm a fund manager, so the name stuck. Big Mike Fund. That's the name of the podcast. If you're bored, you got nothing else to listen to, tune in, give you a little entertainment. And if you misspell it, you can go to bigmikefund.com or you can go to bigmikefun.com. I promise it's not a kinky site. We have a wonderful YouTube channel. Tune in if you want to hear some of the industry experts, cost seg people, passive investors, experts in self-storage, retail, multifamily, industrial. We run industry expert panels typically every 6 months. We have a monthly month and learn. All this stuff is just educational content, no solicitation of any kind. All we're trying to do is build a relationship with you, help you get better at investing, and the hope that you reach out to us one day and look at one of our deals. So it's the law of reciprocity. We serve you with the hope that one day we can be of service on the next deal. Sign up. Scan the QR code. Take advantage of the opportunity to be the first to learn about next deep value deal. You could get on our newsletter list. We produce newsletter every couple of weeks. We produce educational articles. There's a lot of great content. We share a lot. We bring industry experts, as well as when we have a next deal, you'll be the first to hear about it, and you'll get the first opportunity to take a look. Our corporate site is tempofunding.com, and bigmikefund.com is the podcast site. There's a little bit more information on that website as well. I hope to be of service. Love talking to folks. We have a wonderful investor relations team. Reach out. We appreciate the opportunity to be of service. And I don't know if there's any time for Q&A, but thank you for your time and attention.
Of course. Yeah, we can squeeze in one question here. We got a question. Are your deals typically successfully exited within the projected time frame? In this case, 5 years.
So it's a great question. The answer is who knows the future, right? We underwrite for 5-year holds. We've done many deals. Some deals have exited 2 or 3 years. Some deals take longer. There's no right or wrong. So when you hear 5-year estimated timeline, that's the intention, that's the goal. Many of these investments could be exited earlier if the market conditions support it. If there's a strong offer, they could take a little longer. So when folks write a check into commercial real estate in general with an estimated timeline of 5 years, they should be flexible enough to understand that it could go a little bit better and faster, but it could take a little bit longer too. That's generally how real estate works. If the market conditions are not great, I'll give you one example on this topic. We're looking at a bunch of industrial deals, and we've invested with some of these folks, and they're bringing new deals. It's a great time to buy, not a great time to sell per se. So I had a conversation. And asked the same question to a partner in the industrial space, and he said, "Well, I don't want to be a seller in this market. So if it's a deal from 5 years ago and it can wait another year or two to sell in a better market, of course, the chances are it'll take 6, 7 years. But on the other side, it's a great time to buy now, and maybe 2 to 3 years, some of these deals will have an opportunity to exit well ahead of the 5-year time horizon." So the answer is it depends. When there is a 5-year estimated timeline, just take it with a clear and simple understanding. This is an approximate timeline. It could happen a little longer, a little later. You just have to be flexible enough to live through the full life cycle of the deal.
Okay. That's the end of today's session. Thank you, Mike, for being here. Thank you for the presentation, and thank you for all watching. Don't forget to check out the virtual platform to check out the agenda, and we hope to see you in the next session. Thank you,
Thank you
everybody.
all.